Since the beginning of the year, the S&P 500 keeps going up higher and higher. Actually, it trades at the all-time high, and over the past 52 weeks, the market went up by 25%. That makes it very hard to find great opportunities. But wait a second, there are three rock star dividend growers that are actually trading at their 52 weeks low. So that gives you a great opportunity to seize them and potentially buy them at the perfect price. So while you were waiting for a deal, maybe there's one just rolling behind your nose. So today we're going to look at those three companies. I'm going to tell you a little bit more about their business model, about their dividend triangle, and of course, why they are not performing versus the market. So let's get started with the first one I have on my list, StarBucks, ticker SBUX. So I don't think that Starbucks needs an introduction. You're pretty much well aware of what's going on in those coffee chain stores. The company is dominant in North America, but also expands rapidly in China. As you can see on the dividend triangle, the revenue trend, besides the pandemic over the past 10 years, has been on a pretty smooth line, while the earnings are a little bit more shaky, but overall, the past 5 years revenue growth rate is at 8%, and it follows by dividend growth over the past 5 years at 11%. So we're really talking about a super powered dividend grower here, relatively low yield, but as of late, the stock price is going down. So what is really going on with Starbucks at this time? So it all started with their latest earnings report where it was, let's be honest, pretty much catastrophic. So comparable sales was the number that hurt the business big time. So what's a comparable sale? It is when you look at the existing restaurant last year and the restaurant this year, the same one, and see if they were able to grow their sales or not. And as you can see, as global, it's down 4%, in the US down 3%, and in China down 11%. Which this is definitely a big part of why the market didn't like it. The stock price dropped by almost 20%, and it created pretty much a commotion over there. Even worse than that, on top of having weak comparable sales, we also had pretty weak guidance for the rest of the year. So now the management team is telling us that we're going to have pretty much no growth in terms of sales. It is struggling pretty much everywhere. And the reason is because Starbucks is facing a lot of competition. So in North America, on top of competition, we kind of like see a slowdown in consumers because they are getting tight with their budget. It is getting very hard for them to want to spend $10 on a coffee. And in China, we see that they're the highest level of competitors. And while Starbucks keeps opening new stores, it is getting very hard to show comparable sales growth. So it's one thing to open new restaurants, which is always great, but if you're not able to grow organically within the existing restaurant, it shows a big weakness and it's going to be very hard for them to grow over time. So going back to valuation right now, is it the right time to pull the trigger and buy some Starbucks? Well, what I like to do is to always look at the average past 5-year and past 10 years PE ratio to see how the market valued Starbucks. This one is a little bit harder because as you can see on the graph below, between 21 and 22, there was a huge peak because they reported very small earnings. The PE ratio went very high, but that was all due to pandemic. Overall, the company PE ratio is more between like 20 to 30 times the earnings. The current PE ratio is at 21. The forward PE is at 19. So right now, the market as correctly priced Starbucks, assuming no growth for the next 12 months. It's not a super best timing. However, management is already telling us that they are pushing more marketing initiatives. They want to get more information from the customers to expand their products and continue to open new stores. So for the long run, I think that it will still continue to be a great holding, but of course, in the meantime, it's going to test your patience. Full disclaimer, I do have Starbucks in my portfolio. I bought it a long time ago, so I am willing to wait for maybe like a good year, so 4 more quarters, to see how management is able to put more initiatives into play and generate more growth starting in 2025. Now moving on to another business that is trading close to its 52 weeks low, and it's John Deere, ticker DE. As you can see on the stock, on the dividend stocks triangle, the stock price has been hovering around the same dollar value since 2021. So it's been 3 years with absolutely no growth, while the company showed a pretty decent dividend triangle. Well, of course, it all starting in 2021, where there was like this big kind of like COVID hype where a lot of people thought, oh, there you go, John Deere is going to be like an amazing business because revenue and earnings were growing fairly fast, and that pushes the stock price around $150 in 2020 all the way above to $350. So the reason why John Deere is trading at a low price right now is mostly because of that hype. We often see that on the market where investors start to get a little bit ahead of themselves and they start buying for no reason, and we have like a PE expansion, meaning that they're willing to pay a higher price for the same earnings, so a higher valuation than before. And they kind of like just thought, oh, John Deere is going to grow double digit kind of forever. However, when we remember exactly what they're doing, I mean, they're selling equipment mostly for agriculture business, and then you have like some construction and other industries in there, but most of it is selling equipment and services to farmers. And of course, farmers are not going to buy new equipment every single year. On top of that, what John Deere focused on is high quality and robust equipment that made a very strong brand. And this is why they have some pricing power. But that also includes that a lot of farmers will buy John Deere equipment, but they're going to stick to them and not necessarily change it every 3 years because they're not breaking. It is with good quality. Their focus in the US market and the Canadian market makes them a little bit less volatile in terms of currency fluctuation across the world. And going forward, I think that there's a lot of opportunities for John Deere to continue to expand their brand outside of North America. Moving on to the valuation, you can actually see that on this graph right now at the bottom, where there was a strong P expansion and the P ratio went up to 34 times the earnings. But right now, it's kind of like going completely the other way, where the forward P ratio is at 14 times the earnings, and the average over the past 5 years is at 19, while the average over the past 10 years is at 17. So long story short, we do have an interesting entry point for John Deere. We saw that the revenue and the earnings have slowed down in the past 12 months. That's kind of normal. The economy is going to slow down. The consumers are tight on their budget, as I explained with Starbucks. But when you're thinking for the next 10 years, John Deere is a strong brand that should continue to grow its business, include technology to help farmers and optimize their equipment. And we kind of need to eat. So definitely John Deere will be a key player in the years to come. So before we jump to my third idea, that is probably the best one, so you want to stick around to hear this. I want to tell you a little bit more about my investment strategy. So I am a dividend growth investor, but I really focus on the growth. So the idea here is to select low yield, high growth stocks with a strong dividend triangle. So companies that are showing higher sales, higher earnings, and of course, higher dividend year after year. Those type of businesses are thriving. They are well equipped to go through a recession. And I've actually wrote a complete guide to help you identify them and actually make you think a second time if you're a retiree and thinking that going for the high yield is the safest place. It's actually quite the opposite. The low yield, high dividend growth companies are a much better choice for retirees. So I would like to invite you to download my Dividend Income for Life guide at dividendstocksrock.com/income. So dividendstocksrock.com/income. The link is in the description below. This guide will help you understand why some companies are offering a high yield and why they are probably a risk for your portfolio, and how you can change your strategy to integrate a few low yield, high growth stocks and make just your portfolio a little bit better, best performing, and of course, making sure that you are retiring happy. Now moving on to my third and last idea, Nike, ticker NKE. SBE. This one reported a shocking earnings a few weeks ago, and we're going to talk about them in a second. But first, let's take a look at the dividend triangle. So the revenue keeps on growing. We have a 5-year revenue growth rate of like 5.6%. The earnings per share went up by like 8.4, but we can see that starting from 2022, it has been completely a different story. So now we see that there's a downtrend. So already not pulling too much hype, and we see that since 2022 as well, the stock price is going lower, lower, and lower. Actually, right now, Nike is priced as like what happened during the pandemic, which is kind of crazy. In the meantime, though, the dividend kept on increasing, showing an annualized growth rate over the past 5 years at 11%. So what's going on with Nike, and why on earnings day the stock price dropped by 20%? Well, the thing is, news are not great. The company is literally struggling. So sales are down. Converse is doing terrible, as you can see in the latest earnings. But even worse than that, management pretty much told the market to not expect anything great in 2025. So now they're telling us that we are in for at least 12 months, maybe a year and a half, maybe 2 years of no growth or slowing down earnings and revenue. So long story short, Nike explains their business model as this is a growth company is not so much of a growth company these days. So to explain the weak results and the weak guidance moving forward, management explained that there was a lot of competition out there, and the market also responded saying, well, Nike, you're not innovating anymore right now, and this is a big problem. You will likely lose market shares. The retailers are going to have a hard time selling shoes. And of course, again, consumers are getting tight on it. So this one is probably the best high risk, high reward type of play among those three. The safest one is definitely John Deere. But for Nike, what I kind of like about this one is if they turn things around, and they have been doing that in the past as well, because they have a very strong brand recognition. They have an amazing marketing team, and moving forward, they have all the tools and resources they need to grow back the company again, but maybe it's going to happen just in 26, 27. From a valuation standpoint, if we forget about what happened during COVID, so once again, as you can see, that is changing completely the perspective and the average. The stock price usually trades around 30 times the earnings, sometimes close to 40 times the earnings, but right now the forward P ratio is at 22. So which opens the door a little bit for a great opportunity here, especially if the company can go back and report high single digit to double digit growth, which we were kind of used to see from a company that big and that strong such as Nike. So of course, when you look at those three companies, SBUX, John Deere, and Nike, they're not obvious picks. They're not obvious companies that you're going to run into and grab them, but they have been beaten up by the market, probably a little bit too much in my opinion. And if I had some free money on the side, I would probably put a $2 on John Deere and another $2 on Nike. Those are, as usual, not financial advice. This is just my way of saying, hey, maybe you want to put those on your list and start digging a little bit more to see if they make sense in your portfolio. But I think that those are three companies that in a few years from now, we're going to look back and say, wow, that was an amazing time. So I'm curious about your picks. Do you have any companies right now that are trading close to the 50 weeks low that you identified as your next buy? So leave a comment below. Tell me what you think about SBUX, John Deere, and Nike, and maybe about your next best buy idea. And we're going to start a discussion right there. All right, guys. So don't forget to give me a thumbs up, subscribe to the channel, not to miss my next video on next Thursday. And until the next time, don't forget to stay invested.